Welcome to this Property Life podcast. I'm Caroline Claydon.
And I'm Nick Claydon.
And today we're going to be talking about deal analysis. This is one of the core skills that you need to have as an investor or as an entrepreneur, regardless of if you're in property or not. You need to know how to do the numbers. So talk us through, Nick. What are you going to do? Get those specs on?
Spectacles are on. Right, what we can do is talk about probably, I think, the typical kind of deal maybe that a member might bring to us. So we have our membership in the Property Wealth Club that maybe come to us and come up with some examples. Yeah, often they get us, can you have a look at this deal? Tell us what you think.
Yeah, it's like a little deal clinic, isn't it?
Yeah.
They're looking at something, they want to check that they've covered every angle off. And so they bring it to us and then we sense check it for them. This is typically the type of...
I think this is probably the type of deal that maybe somebody who's just maybe started out or thinks what buy-to-let is kind of brings to us, and we often kind of have to rip it apart a little bit, don't we?
Yeah, well, what makes a deal bad?
Yeah.
And what makes a deal stack up? That is the burning question that when people are starting out, they stumble over. And what we also see is quite a lot of analysis paralysis. They maybe over-assess certain things and then do nothing. So it's great for them to be able to have a platform to just come and say, right, this is what I've got. This is what the data I've found is. Does it stack up?
Yeah, I think there's also an element of sometimes we can look at the easy route and think that that's the best route. So something easier is not necessarily better, which is what we shall demonstrate. So what I've done is I've had a look at a typical maybe area in the country that people might be looking at. So pretty much at random picked Bedfordshire, kind of home counties, north of London, kind of brings in kind of bordering onto the Midlands, the typical kind of area that maybe a southern-based or Midlands-based investor might look at. But, as an example, it can work really for everyone. So just having a quick look for, I guess what people often bring us is like a typical flat. They think, a flat is what people want to live in, a 2-bed flat. That's my perfect kind of rental property.
It's a good little starter. Normally they're cheaper, so people feel that their risk is lower. But in actual fact, flats come with their own problems.
They do, but let's have a look at an example. So 2-bedroom flat, as you can see, I'm going to put it up on the screen in a minute. So anyone who's listening to us on Spotify or Apple, do recommend that you jump over to YouTube. I'm going to send you get some visuals as here, but I'll talk through it as best I can also. So typical 2-bedroom flat, not like top end, but kind of I would say median kind of level flat in Bedford is around about 160,000 to buy. Looking at rents for those kind of properties, we're looking, I see you're getting your calculator ready.
I love a little calculator.
Rents roughly around about £1,100 per calendar month of these. Often I think, we get brought examples of things that are ready to let. I think for somebody new coming to mind, they think it's easier to buy something that is just ready to go.
Yeah. Again, because they're always terrified about working with builders, and I can totally understand that.
Yep.
That's why starting relatively small, lower risk is more sensible. And that refurb builder, you're looking for your kind of handyman, one man band that can do, fit a kitchen, do joinery, basic plumbing.
There's levels, aren't there? There's levels of builders, and we're talking about, your, as you say, your one person band operator. But as I said, in this kind of example, what we're looking at here is something that is, ready to rent essentially. So minimal work, and I think a lot of new members coming to us will say that, this is easier to do. But let's just dig into the numbers.
So
would a deal like this
160
actually
purchase?
160 purchase?
So that at 75% gives us a mortgage of 120.
Okay, so deposit required would be about 40,000 plus some extra costs.
Yeah, you got your legals, brokerage,
stamp duty.
Lovely stamp
duty. Thanks, Rachel.
Yeah.
Okay, so what would a rough mortgage, what percentage would we be using for mortgage at the moment?
Well, we want to stress test because I guess, we can get mortgages of 4 point something at the moment, but we're probably closer to the 5 mark.
It depends how you look at it.
Again, if you're doing limited company or if you're doing it in your own name. But
and it's also,
I would do a stress test at 6% just to be safe.
But you can also look at, I think I'll do a whole episode in this, headline rates for mortgages and what you're actually paying.
Yes.
But so I always look at what are the best no fee or very low fee mortgages. And so you're around 5.5. So let's use 6.
Yeah, 6%. So 120 times our 6% gives us an annual interest of 7,200. And I pressed times instead of divide.
That's right. So that'll be
7,200 divided by gives us a monthly mortgage of £600.
So straight away is £600 on your
What's
mortgage. The rent is 1,100.
Okay.
So then I think that's where a lot of the new investors stop. They would think, all right, my rent's 1,100, my mortgage is 600.
We're
I'm
good.
doing all right here.
Well, if you think about it, there's three big costs that need to come off your rent. Is what I call the three M's. M for mortgage, which is £600 in this scenario. M for management, which is typically maybe 10, 12% of the rent. And then you've got your MOE, monthly operating expenses, which everything falls under.
Like what? What under your monthly operating expenses?
Your
And most people think
insurance, your insurances, you have to even calculate in void periods, wear and tear, maintenance, I've said insurances, haven't I? Ground rents or factoring fees, although we don't really like to buy anything with factoring fees.
But in this example, we're looking at a flat, which is often a typical purchase for more of an amateur investor. So it is going to come with service charges. So you'd expect probably on a flat of this value, the ground rent and service charges might be £120 a month.
Yeah.
So that's coming straight off.
So we've got mortgage of 600, management at 12% of, let's say, your 1,100. And then you've got which we tend to use a percentage of the rent anywhere from 10 to 15%. So if we want to be super cautious, we'll use 12% for the management and we'll use 15% for the All right. Are you happy with that, boss?
Yeah, but I am going to strip management charge. I'm going to strip out of there your ground rent and your service charge, because on a flat that is going to be more. So I would say, do your Mo calculation.
So my management is going to cost me £132 a month.
Okay.
Okay. And then we're going to use our 15, did we say 15% for our Mo?
Do you want to be super cautious?
Yeah, and we should be when we first start. That's 165.
Okay. So we've got our costs are now mounting up. So 1,100 minus your 600.
Okay, let me get on it.
Yeah.
Minus our 600. Minus our, what was the management? 13, what was it? 132? That's what I think it was. Minus 165, was it? Okay. So we're now down to a cash flow of what's left over of £203.
And now you've got to take your service charge off, which a lot of people would forget. So I'm going to say on a flat of this kind of value, ground rent and your service charge might be 100, 120 a month. So let's call it 100 a month. It's going to be that.
Okay, so we're down to £103 profit.
Right.
And you've invested 40k plus costs.
So what is the return on that capital invested?
So your ROI calculation is your profit divided by your money invested multiplied by 100. So in this scenario, if we're saying our profit is 103, our annual profit is 1,236. We divide that by 40,000, which is our deposit. Now we know it's more than that because obviously we've got costs and the likes.
Yeah, let's just call it that.
So you're looking at an ROI of 3%.
And the reality is you get better in the bank right now.
Yeah. I mean,
but it's not a great return on investment. So something that can, on the surface of it, look like a good solid investment, a nice flat, ready to rent in a good commuter town. It looks initially like that could be a good investment. But as soon as we actually start putting in the real costs, and I'm going to chuck another thing in here, as soon as you start putting the real costs in, then you suddenly see that the reality is really quite weak as an investment. Yeah. And now I'm going to chuck in here, because you're buying a flat, and who is a typical renter of a city centre flat in somewhere like Bedford?
It's going to be a young professional, starter out, or maybe first flat from moving out of home, maybe a young professional, something like that.
Exactly. And I think a lot of new investors come to us and go, they look at kind of the shiny city centre flats and go, I want to rent to young professionals or professional tenants. And this is, I think, a big error when you're coming into this property investment game, because your young professional or professional tenants, they might rent a flat for a bit, but what are they actually doing? They're aspirational. What are they actually going to be doing here?
They're going to be saving up for a deposit. They want to buy their own property. That's ultimately the goal that they have. And so you find that it's quite transient. So that void period that we've calculated into our Mo can, really start to.
Well, let's have a look at how my impact. Let's say, even if you have 1 month's void a year when a tenant leaves and you've got a month to turn it around and get another tenant, and you're going to lose a month's rent. Plus, I'm not even going to calculate your agent fees on, for getting a new tenant in as well. Let's just take that out of it, but you will have to pay that.
But bear in mind that void is actually calculated into our MO. We've taken 15% off every single month. That also includes our annual gas safety certificate and all of that stuff.
So what's
So
15% a month?
it was 165.
Yeah.
Let me just double check. It was 165. So you multiply that by your 12 months. That 15% really should cover.
It might cover 1 month void. I'll give you that. But what if you've got tenants that turn around every 6 months and leave on a shiny city centre flat?
I mean, you've got annual costs here through your MO calculations of just short of £2,000, 1,980.
1 month's rent
Is 1,100.
is 1,100. Take that off.
I know,
So what have you
but
got
I
left?
think you're being really harsh because I don't think they move that quickly. I mean, saving, let's face it, for a deposit for their first home, it's going to take them longer than a year.
It's reality, and you might get tenants that.
But if they get married, that's the kicker. They're young, they get frisky, they get married, and then they join together. And now they've got double buying power. Then they buy the house.
The point is, 1 month's rent basically takes 1,100 quid off that, plus fees to relet it.
I mean, I've just done a reel on Instagram about the costs for letting agents, and it is absolutely insane. Them charging per property for using their CRM system is just absolutely insane. Because
I tell you, letting properties is a tough business, and the margins are really tight. So you can look at letting agents; they are going to be charging you, for lots of things that you might not think they're charging you. That's reality. We're actually going through a process ourselves at the moment of analysing what our agents are charging us and actually all the hidden fees. I say hidden fees because they don't really advertise them that much. It's only when you really dig into it.
No, but look, let's be honest. We kind of neglected our buy-to-let portfolio for a while we were growing the other bigger stuff and doing bigger developments. So now that we've got the headspace, we're going back and revisiting. So, but to fight tooth and nail to show us a list of your fee schedule, well, we still haven't actually seen one. A fee schedule from a letting agent. Yeah. You have to go and look at your annual statement, your letting statement from your agent to see where all the fees are.
And they add up. And that's why even if you bank on a 15% MO, that can disappear. That can disappear with a couple of with one tenant turnaround, one tenant void.
That leaves you 880.
Yeah. Then and that's got to cover you the whole year.
Your annual gas safety certificate straight away is like 120 to 50, 120, 150 quid. And Legionella's if you're doing that, and
the rest of it,
all the electrics and the inspection. Of course, they'll charge for an inspection.
A little bit of maintenance. You've got to accept that there will be a bit of maintenance, and your MO is gone. Yeah. And
that's why we calculate it.
It is, but what I'm saying is there are other types of investment where there's less risk of tenant voids, which is what we're going to come on to now. Flats generally are more transient. You attract a more transient type of tenant because you've got, if you're looking for that kind of young professional living the dream on the city centre flat, sipping champagne on the terrace, they're going to buy a flat themselves. That's what they're aspirational.
Or they're going traveling.
Yeah, or they're going traveling, or in this current age, how safe is their job? Yeah, and if you've got a couple and one of them loses their job, they can't pay that rent and they'll be moving. And they have a lot of these young people have options. They can move back home. There's other places they can go. So you are at risk with that type of tenant, the restricted tenant pool that you're fishing in for a city centre flat.
Okay, I get it, but I'm going to also say, well, we always have our second exit, right? So in a scenario where maybe all the costs are getting eaten up with letting agents and tenants moving in and out and all of that stuff, there is an option to give it to the council and do social housing.
If they'll take a flat, a lot of councils don't want flats, because this is moving on to, where we're going with this is that if you actually look at who wants to rent houses, properties, what are they looking for? The majority of people looking for flats, we're looking for houses. Generally, they're looking for houses, particularly when you're looking at social. Yeah. So if we look at a different example of what, as investors, what professional investors would look to invest in, you can look at, here I found, you have to maybe widen your net a little bit from somewhere like Bedford. Okay, so instead of just looking at Bedford itself, I put a 30-mile radius around it, 40-mile radius around it. And within that, here's a town called Corby, not that far away, a bit further north, half an hour away. But here you can see an example of, you can buy a house, 2-bed house, for around 95,000. You're going to spend 15 to 20 on a refurb here, though, because this one is not ready to rent. Again, if you're listening to us on Spotify, jump over to YouTube, have a look at what I'm actually showing you here, because you're going to be able to see a property that does need a bit of refurb, not major.
Okay, so we're buying at 90,000.
So we're now buying at 95.
So we're needing
Although
£22,500.
I'm just going to jump in there
deposit.
and say it's marketed at 95. Does that mean you can't buy it for 85.90 or maybe a bit less because it's a bit distressed? Fewer people in the market for that.
Yeah.
It gives you a little bit more negotiating power.
Okay, so I've said 90.
Say 90.
That means 22,500 as a deposit, and you're saying 15k spend?
Yeah, let's say 15. It just needs a light refurb, kitchen, bathroom, liquor paint.
Okay, so we're in for 37 and a half. So we're still not at our 40,000 deposit for the city centre flat.
Yeah. Okay. But now we can look at what's the mortgage going to be. If we just look at this as a straight, without doing the kind of refinance bit after, let's look at just on the purchase, what is the mortgage going to be?
Okay. So we're 75%, 67 and a half times 0.6%. We are at a mortgage of £337.50.
Okay.
You haven't told me what the rent is yet.
I know. I'm just waiting to drop that little one in.
This is how we get our kicks.
If I now have a look at the rentals for 2-bed houses in Corby, you're looking at around £950 to £1,000 a month.
So we'll say 950 to be cautious.
Say 950 to be cautious.
Okay, so we're 950 minus the 337.50. Is that where we're at right now?
That's where we're at.
Okay, so right now we've got £562.50 to play with.
Okay, now take off your operating expenses. Now this time we don't have service charges because it's a freehold house.
But I'm still going to take 15% more off.
You can take 15% if you're happy with that.
I'm going to do that. So remember 562.50.
50.
Right, where we're at. So we're at 950 rent times 15%. So we're at £142.50 for the mo.
Right. 562.50 was the number you gave me to remember.
562.50 minus 142.50. I think it was. Right now we're at 420, and we need to take off management.
Okay.
Right. So management is, what did we say? 12%?
Yeah.
12% of. So remember 420.
I'm going to have to check your maths.
I know. It's all the memory is the issue here, not the maths. It's actually remembering these numbers, because I would normally do back of a fag packet with my phone and a little.
Okay, let's start again on this one.
What?
Yeah,
what? Yeah. You don't trust? You're auditing me.
I am.
Oh,
okay, so let's go. Let's start.
It was just a memory issue.
Rents at 950.
Yeah.
Okay, the mortgage was 337.
Yeah.
Okay.
So you trusted that bit.
And then we got the your 15% for your MOs.
We said 950 was the rent.
950 at 15%
is 142.50. Okay,
yeah,
I think I missed 50p out.
Oh, you might have missed 50p. And then the agent fee was
12%. So that's 114.
114. As I said, you don't have ground rent and service charges here. So 950 minus 337 minus 142.50 minus 114.
Okay, so now we've got a cash flow of 356.50.
650.
Yeah, that's good. That's good.
So that is straight away you can see.
We have locked in £37,500.
We have, and that maybe comes on if you go back to our previous episode. You can look at the 1% rule and how we use that to work the buy, rent, refinance model.
Yeah,
we will probably do an episode on that in a bit more depth, so you can see how the next stage of this might work, where you can extract hopefully as much of that initial investment as you can, which allows you to scale. So we'll talk scaling in a subsequent episode.
Yeah.
But just for now.
Do you want to do an ROI on this?
Just
more maths.
Yeah. Okay. More maths. Okay. So 356.50 is your
times 12, right?
Yeah.
And then we divide that by our 37,500 times our 100. We're at 11.4% ROI. Right. So it's significantly higher than your little flat in the city.
Actually, now it might not look as nice, I would argue, but here you've got a proper investment. Now this is the kind of investment that a professional investor would look at. You've got 11.4% ROI on that one, and that's before looking at maybe refinancing and pulling out some of your or all of your initial investment. You've got a healthy cash flow per month that's stress tested. And also, you don't have the service charges, so there's nothing for that to worry about. And critically, I think for me, you've got a property that is more attractive to a broader range of tenants.
Correct. And they're far more likely to be there for a longer period of time. So the 15% more is maybe a little aggressive.
It might be a bit aggressive because you're probably not going to have that turnaround we would for professional.
And also less turnaround, and the maintenance should be lower because you've just spent £15,000 refurbing the place. Maintenance-wise, that should be lower, certainly in the first couple of years. So you could get away with a 10% mo in the first couple of years as well, which means that your cash flow's higher than that 300 50.
Yeah, exactly. But, in terms of, as I said, the tenant profile, who you're looking for, who's going to be renting a house? You've got
Small, young
young
families.
families, the key market. We've had properties up here in Scotland for more than 15 years, there's one, we've got still one tenant that's still in that house.
I know. We've been good to her and she's been good
She's
to
brilliant,
us
yeah.
because, we haven't put the rent up every single
Yeah.
year. We haven't been aggressive with the
No.
rent, and therefore she very rarely comes to us to do anything. And she replaces carpets
She
and
does
does
it.
stuff because she's made the decision, well, I'm getting a good deal on the rent, so I'll, pay for
Yeah.
the carpets that I want. And then it works well for both of us.
But we've had no voids in that house in 15 years, not one.
Yeah. And that's another business decision as a landlord that you need to think about is what's important to you, squeezing every last penny out of each property every single month? Or is it having a kind of hassle-free, hands-off income that, is not going to cause you too much bother?
Yeah.
We went for the latter.
Well, look, we went for the professional perspective of we want properties that are going to cash flow regularly and squeezing a bit of extra rent versus no voids. When you actually do the maths, it's not a difficult decision because voids absolutely kill your profit.
But it does
It's an
actually
illusion.
depend what else you're doing in your business. And we made that decision because we were very, very preoccupied with other developments and other projects that, us reviewing the buy-to-let rents every single year and, asking for the rents to go up, that just was not a priority for us.
It's also stability of income was more important.
Yeah.
Right.
Yeah.
So, that's, I think, the difference maybe between a more amateur mindset, more professional mindset.
Yeah.
And that's what our members, our Property Wealth Club come to us. And that's kind of the prevailing message that we teach, which is, we're building business here. It's not personal. It's not, you've got to try and take away any image you've got of, the city centre flat with the young professional sipping champagne on the balcony. That's not what professional buy-to-let investment is. This kind of property, 2-bed house, in a, not being rude to anyone that lives in Corby, fairly nondescript Midlands town, that is your core buy-to-let engine of growth. And you've got better margin of safety. You've got longer term tenants. It's just what we look at as professional investors if we're looking to actually make money, which most of us are. So why would anybody still buy a city centre flat?
I think, well, you touched on the fact that there are certain mindsets that if it's, say, a new build or it's relatively ready to move in, that it's hassle-free. But of course, they can't then add the value to then pull the money back out and go again. So they are then parking that 40K. And the only way they're going to buy another one is if they save another 40K to get going again. Whereas the wee Corby place, while we've bought it a little bit below market value, we've spent some money on it, we're going to push the value of that up, that we could go back in and pull our £37,500, maybe not all of it, but let's say we get at least half of that back and still have it cash flow a couple of £100 a month, then we can at least have a platform to go and scale and do more. And that's the key. If you have one property, you are really, really risked.
You are.
Really exposed. You're exposed.
You're at risk. And this is where we see this a lot. We say, we get people that challenge us. Property doesn't really work because I had this flat and it was a nightmare because, I had a nightmare tenant and then the boiler broke and I didn't make any money off it. It's like, well, firstly, you had one.
Yeah.
And you're at risk of that because if you are unlucky and you have a nightmare tenant, which I'll dig into in a minute, it's going to hurt because you've got one. And if the boiler goes, it's going to hurt. Nightmare tenants can generally be avoided by vetting your tenants properly. Yeah. So having a good agent that's going to vet. Where I see nightmare tenants is normally when you get more an amateur style of landlord who's maybe trying to cut a few corners, doesn't really vet tenants properly, and surprise, surprise, they have a bit of a nightmare. Avoid that. And
there are people that do everything absolutely right, but then there's tenants that just play the system, right? They know the game and they play it. So that you can never ever be 100%.
No, you can't. But
free of that. That's the price of you getting 11% ROI versus 3% ROI in the bank, right?
Everything has risk. Doing nothing has risk.
Yeah.
But essentially, you look at if you can reduce, risk of nightmare tenants.
Yeah, you can do that. Yeah, for sure.
Yeah, you can. So, what we're looking at here is really what I think it's about if you're looking to do something on the side, grow a buy-to-let portfolio. It's not about doing one. One's too risky. You need to have a method of scaling so that you have multiple properties. If you have, let's say, 5 and a boiler needs to be replaced in one of them, the rent from the others covers it. You're not exposed to one thing going wrong with one property. So it is all about scaling, and it's about allocating capital, for me, into assets that can move you forward and not leave you parked. Because one flat on the side,
Yeah.
it's not really going to do it, is it?
What's it going to do? I mean, my ideal client to work with is one that is looking to just get out their job. They're looking to get property to replace their income so that they can sack their boss. That's like my favorite avatar of person to work with because they're intelligent, they're driven, they're hungry. They know the vehicle that they want to use, and it's just they need the mechanics and actually just pointed on the right path to get there. But that replacing the income is my favorite. But lots of people invest in property for different reasons, right? A legacy for the kids.
Exactly.
Don't give it to the kids. They won't appreciate it. In fact, what value does anyone put on anything when they get it for nothing, right? Or the kind of just retirement fund. I mean, pensions are completely screwed. So lots of people are coming to us and saying, I need a different plan for my retirement.
Exactly. But, buying yourself a problem property is not going to help. It's just going to really turn you off property. So it really is about allocating your capital into the right type of investment. We look at, to summarize, houses rather than flats. Flats come with service charges and extra costs and restriction on the tenant profiles. Houses are a much more solid investment. Yep. Freehold, you own it, more popular and easy to rent and longer term tenants.
Buy-to-let demand right now is just off the charts, isn't it? I mean, we're buying buy-to-lets this year.
Absolutely.
Whoa, why are you going backwards to the right back to the beginning? It's just like, the demand is there. Why wouldn't we do it?
I love a buy-to-let. We bought a bulk of ours probably 15 years ago. But look now, we've held on to them through everything that's happened over the last 15 years. It's been a lot. Rents have really jumped. A few years ago, rents averagely were $550-ish for these properties. They're now up at $850, $900 for these properties. But the mortgages haven't moved. We've locked those in, so we're, instead of making £200-300 cash flow per buy-to-let, some of ours are doing like £500-600. That's almost HMO level income from a buy-to-let. So, buy-to-let is a long-term play. It's a long-term wealth builder. Yeah. Get it right at the beginning. These houses will pay you for a long, long time, but get it right.
Got to get it right. We're already in legals for a buy-to-let this month, and we've got plans for more this year. So, yeah, we are full steam ahead on the buy-to-let as long as you got the numbers right.
Absolutely. Right. Great. Okay. So thanks for that. Good maths.
Enjoyed that. Yeah, thanks. Well, it was more the memory that was the problem letting me down there, but I can do the maths.
Right.
And I wasn't actually very good at maths at school. It took me an extra year to get my higher maths, but I can analyze deals.
Don't need to be like A-level maths to be able to do this,
right? You don't need to do this. Yeah.
Okay. So, I hope you found that useful. Further episodes will be coming up, more digging into, the real reality of buy-to-let investing, what you really should be looking for. We can talk about experience that we've had over the years dealing with most things that you're probably going to come across. So we'll be doing more of these episodes, going into the numbers a little bit more and showing you what really, really works out there. So thanks for joining us. Anybody wants to kind of connect with us more regularly, we've got our Property Wealth Club. There'll be a link below in the episode notes. Caroline, how does anyone want to get
my
in touch
Instagram?
with you?
Yes, so carolineclaydon.property on Instagram, and apparently I'm on TikTok as well. So there we go. Young and trendy, does it? No, not really. Yeah, that's not what the boys would say. Anyway.
Thanks for watching, and we'll see you next time.